Hello traders, do you know why the market is always hunting for the stop losses? Every sudden spike or every sudden drop you see in the market is no accident. This is the market trying to seek liquidity. Liquidity is the fuel of price movements. If you master this concept, you will be able to understand how this market works. So in this video, we are going to look at how markets hunt and generate liquidity, and we are going to look at the external range liquidity and the internal range liquidity. When you master these concepts, it will help you to avoid certain things in the market that will always make you lose your trade. So hang on as we dive deep into these concepts. So let's start by looking at what liquidity is. Liquidity is the heartbeat of price action. Liquidity is what drives big and small moves. So you need to understand that liquidity is everywhere in the market. It is simply money, and liquidity can be classified into two zones. We have the external range liquidity and we have the internal range liquidity. So let's look at these areas in a chart example and see how we can identify these areas. This is a diagram that shows an example of price movement. So let's look at here. We have price moving, making a higher high and a higher low. Price making a higher high and a higher low. So in these areas, we have this circle. When price creates a swing high here, we mark it as a circle, and the same thing applies to swing low. All these areas you see here are liquidity areas. Although liquidity exists in every price move, liquidity is everywhere. In this scenario, we have the external range liquidity. What are these external range liquidity? All these our swing highs and swing lows are what we classify as external range liquidity, external range liquidity levels. What we have here is that price moves from external range liquidity to internal. Always have this on your mind. Price moves to external, create a liquidity area, then move to fill up internal liquidity before continuing up to an external liquidity. So when price creates a liquidity area, it moves to fill up imbalances or takes liquidity in the range, then move to take that external liquidity. So what we have here is a series of stop loss order placed around these areas. Price will always gravitate to this area to take up a liquidity in order to move. This is what drives the market. When price starts from this place, it moves up, creates a high here. What happens here? Why this price moves down? There are sellers who entered the market at this price range. When sellers entered the market at this price range, it causes this price action to move down to this area. When price pushes down to this area, we have these sellers who places their stop loss order here. All this area becomes a key liquidity area, and price always gravitate to this area to take up those liquidity. In the internal range liquidity, we still have take profit orders, we still have stop losses orders, we still have pending orders. So price always move down to fill up these imbalances. Takes such orders before it moves. So visually in every area of the market we have liquidity. So spotting these liquidity areas is very crucial for a profit because most of the entry you will be making in the market are based on what price, based on these liquidity areas. And to make this entry, you have to wait for price to take up liquidity before you enter the market. That is the secret of every profitable strategy. The secret is that you wait for price to take up liquidity and trade in the opposite direction. That is it. Like here now, we have price starting from this, come to this area. We know that we have a lot of liquidity here. When price drops, it takes all this liquidity, all this internal range liquidity. When you take all this internal range liquidity, if there is no other liquidity for price to take, price has to seek for another liquidity. And where is the nearest point? It is this point. Price has to gravitate to this point. We have a break of structure here. It has a break of structure here to it forms another line here. Comes back, fill up those imbalances, take up liquidity here. When there is no other liquidity to be taken, price has to gravitate to the nearest liquidity zone and take it up. That is what price keeps doing. We have another scenario which price, when price comes to this area, let's assume that we have liquidity around these areas. Remember, price has taken this liquidity here, create here. We have a lot of sellers who still have their stop losses placed here or their sell stop placed here. So price gravitates, fill up these imbalances. We have buyers who are still active in the market who have their stops placed around this area. So market failed to this point. Still take this liquidity of the buyers, take their stop losses down. In this kind of scenario, market has taken liquidity on both sides of the range. It first took this liquidity on the buy side and still take this liquidity on the sell side. When market took this liquidity, we have a market structure shift here. We will be definitely looking for a sell position. Then when market take this thing, it creates area of imbalances here. We have traders who entered market at these various points who have their stop losses here, or traders who have their take profit there, because take profit is still a market order. So price have to still gravitate to that area and fill up those areas. When price fill this area, price move down, fill this imbalance, move up in a range. What we are seeing here is that price is moving in a range. To this point, we have people who trade the range, the sideways market, who believe that when price goes to this range and fell to this point, it come to this point, they will enter into a sell position and place their stop losses here. Price move back, fill this internal range liquidity, create another range. What do we see here? We see an area of manipulation, a sweep. We have a lot of liquidity, equal highs in this area. We have a lot of liquidity here at this top. We have a lot of liquidity at this bottom. What price did is it gravitates around this area, swept all those liquidity. What do we have here? We have some traders, breakout traders who are willing to buy, who are buying, thinking that this market will continue upwards. They think that this market will continue up. They buy into this position, place their stop loss maybe below this, a little bit below this range, What did market do? After market must have taken liquidity on the of the sellers, have taken liquidity of the sellers hit their stops here. Markets have to retrace and hit the liquidity take the liquidity stops of the buyers and gravitate downwards. What do we have here? When market gets to this level, we still have some sellers who believe that well, price has gotten to this level, let's enter the position. Price takes them out and hit their stop losses. In some scenario, we will have a price action like this. Price will hit this level, manipulate traders into taking long position with the hope that markets will continue into this bullish movement. Maybe when it comes here, it will fall down. That is what drives the market. Liquidity, when you understand what liquidity zone you are in, you'll be able to dictate which area, which side is this market going to go. Like in this scenario, when you must have known that price has taken its liquidity on a particular direction, market always gravitate to the opposite direction because that is the only thing market do. Without liquidity, there is no price movement. So always look for these areas of liquidity. That is where you will make your money. That is where the truth is. So let's now we must have understand this external liquidity, which are normally in our highs, swing high and swing lows. Let's go into further discussion on internal range liquidity. Internal range liquidity. In an internal range liquidity, we have some kind of imbalance in the form of fair value gap. What is a fair value gap? A fair value gap is a three-candle pattern. When we have a candle, the first candle wick is not a match to the third candle wick, leaving a very big gap on the second candle. In this candle, we have the wick here, and on the third candle, we have the wick here, and we have this big opening of price on the second candle. Market always gravitates to this point to fill up this imbalance. Market will always gravitate to this point to fill up this imbalance before continuing its move. That is what the market does. It doesn't matter when this happens, it always happens. It always happens. Market always come to fill up this imbalance. This is a liquidity area. We have buyers who will have their buy orders here placed at this point, waiting for market to get to this level to buy into this position. The same scenario applies to a bearish market. We see this three candle pattern. We have this gap here, which is a bearish fair value gap. When price returns to this level, it taps into this fair value gap to continue its movement. This is one example of internal range liquidity. The second one we have here is an order block. An order block is an area where a large block of order which has not been tapped into is located. Market always gravitate inside this area to fill up those orders. In order to plot a valid order block, we have to look at where the market has been. If market is pulling back, let's say pulling back to a certain range, we have to look at the last candle. Like market is coming from a bearish scenario to a bullish. We have to look at the last bearish candle and use it to plot our order block. When price returns to this order block, price tends to continue in its original direction. This is another block. But in this kind of scenario, there's other blocks that are not invalid. Other blocks mainly associated with fair value gap. We have the fair value gap for us to be sure that this order block is a valid order block. Another one we have is equilibrium midpoint. When market moves to a certain level, this liquidity, this an external liquidity, market always gravitate to the equilibrium before it continues its movement. The 50% level serves as a magnet to price. Market mainly returns to this level before we can enter into a position. So when trading in the market and you have a swing low and a swing high, when market makes a high, you have to wait for market to return to this equilibrium level because that is where a market returns to before it continues its movement most of the time. So this below this equilibrium is normally considered a discount zone if you are in a buying a position and above it is a premium. So when market returns to this level and taps into a point of interest, which can be another block, a fair value gap, or any other one. So we can assume that we can buy into that position. We can buy into that position or sell into that position, whichever direction of the trend we're looking at. So always wait for market to retrace down to equilibrium because that is where price action. But sometimes we may see price comes to this level, create a kind of low here and continue up and continue up. It happens at times in the market, but the most accurate trade you make is waiting for market to come to an area of discount or before taking a buy position. So that is what it is. Any point of interest or fair value gap or other block we see in this premium area, we will not be taking the trade. Market opening gaps. What are these market opening gaps? Most of the time at the end of the trading week, when price closes in a particular price range, in the opening day of the new week, at times we see gaps that forms in the market. We see a price opening at a certain level, leaving a huge gap where the close of the previous week was. So this gap acts as a magnet to price. What happened here is a volume imbalance. There was no trade that occurs at this particular range. So market always gravitate towards this area to fill up those gaps. This area acts as a direct magnet to price. So you have to watch out these gaps. It occurs mainly on weekend, but in some assets like indices, it occurs on weekend as well as opening market days. So you have to be watchful of these gaps because they always serve as magnets. Markets will mostly return to this area to fill up these points. So let's go to live charts and look at how these things works in the real world. Let's use this as an example. This is British pounds, Japanese yen. We have price being in a bullish trend. Our order flow is bullish. Our order flow is bullish. In this market scenario, this was the highest point the market reached, and this prior to this high, this is the low. This is another low, swing point. So in this scenario, how do we determine the place price is going, or the place the market price is likely to go? Assuming that we are looking at the chart from this angle, price was in a bearish trend, and this is the swing low, the major swing low. Price is in a bullish trend, it creates this higher high, then price retraces back to this point and swept this liquidity. This is not a valid break, this is just a sweep, a liquidity sweep. Price reach to this level, creates a range, then comes back here to sweep liquidity. Price swept this area. What do we have here? We have a pile of orders here, stop loss orders here. That is why the market gravitated to this area, swept all these liquidity areas here. Then it traces up. When price did that in a very huge move, price leaves an area of imbalance, which is a very big fair value gap here. A very big fair value gap. As you can see, this is this candle, and this is the first candle. This is the middle candle, which is the second candle. And this is the third candle. You see the wick and the wick. You see the range. When price takes out this liquidity, price tends to rebalance. Price always tends to rebalance. Price went down up here to rebalance, to fill up this equilibrium to some certain level, then still generate another liquidity. So still, we call it engineering another liquidity. Price engineered another liquidity here, creating a high inside this structure. Remember, this is our main structure here. This is our price range. We are in a bullish trend, but this is a price range. Price is trading inside this range. Here, price creates a high here inside this structure here. And then when price was doing that, we still have when price move to these directions, we have some areas of imbalances that price created. We have a range here and a fair value gap here. We still have our order block at this price range. We have our order block. This is the last bearish candle before this change in state of delivery here. So this is our large bearish candle. This becomes our order block. Price moved down to this range, filled up this order block. We have some manipulation here, and when price filled up this order block, we have some manipulation here. There's this liquidity. It gravitates to the next liquidity area, which is this high here. When price takes this liquidity here, it engineered a new high here. And sellers take control of the market. They took control, which is short-lived, to price gravitates, and when price was moving to this direction, it keeps creating series of imbalances here, and creating a series of imbalances here. When price creates series of imbalances, price retraces from this level to this level to fill these imbalances. If we take our Fibonacci tool and mark this level, we will see that this fair value gap here is within our discount area. And why this one is not in the discount zone? This one is in the premium. As you see from the example, what we discussed earlier, price ignored this fair value gap. Price ignored this fair value gap as a premium, smashed through it, then came to this one at the discount and respect that. Price respected this fair value gap here. Price respected this fair value gap here. Then from this range, when price must have taken liquidity, it gravitates to the upside. Which next liquidity is it seeking for? This high. This high. When price swap this liquidity area, when price swap this liquidity, then we have an area of imbalance here, an area of huge imbalance here, which is a fair value gap that price is likely to return to. That price is likely to return to. If we should take our Fibonacci and stay plot this range, now here, we see that this is our discount area. From this line here is our discount area. And this is the middle of this is a very large fair value gap. We always wait for price most of the time to get to the middle before taking in our position. We still have another block here. That was not tapped into. So this is how a market moves. Market is always hunting for liquidity. It is always engineering liquidity. It is always generating liquidity. When price lets out this liquidity area, this one here becomes a valid place for price to gravitate to. It becomes a valid place for price to the next liquidity target. So market comes to this high, create this high. This is what we call a liquidity trap. When market goes to this high, it trap traders. Some traders who think that, well, maybe the market is not going to, get to this level. It tricks them to go into a sell position. When they get into this sell position with their stop loss order here, market then reverses to hit this high here, take out this high, then still take out this liquidity here. When market uses this low to take out this liquidity, here becomes our new low here, and here becomes our high here. Market takes it out, then move down to fill up imbalance. We have a little fair value gap here. We have a little one here. We have our other block, another block here, another block here. Price returns to this range, take some liquidity here, then gravitate to the upside. As you can see earlier, we are in a price range. Price has not broken this major high. Price has not broken this major high for some time. Then all of a sudden, when price gets here, what do we have? We have a sweep, a liquidity sweep, a liquidity sweep. So this liquidity sweep, price swap liquidity of the whole liquidity in this area. We have a low here, a high here, and we have another high here. Price came and swapped those liquidity. When price swapped this liquidity, take this high, it came down to this level. It returns to this range before continue this move. We have a valid breakout structure here. When price broke structure here, it continues in the bullish scenario. Here it becomes our new low here. That becomes our new low. That becomes our new low. Market will, when continue the same movement, you get to this level. Put in a low, put in a high here. Then retraces to fill this imbalance. Let's take our Fibonacci tool again to draw here. As you can see, price reaches this imbalance, area of imbalance on our discount zone, which retraces from there. Then this is the closing of a week. At the opening of this week, what do we have? We have an area where trade did not happen. Market closes here at this point, then opens at this range. This range becomes our area of imbalance. Market always gravitate to these areas. These gaps always serves as a magnet for price. When market closes at this range, it opens, taking liquidity at the top of this range, then have some push up, place another liquidity here, then market drops down to fill these places. So this is how the market moves. This is the price action for you. Liquidity concept is very, very important, because if you master liquidity concept, you'll be able to trade effectively. This is a serious liquidity concept. Next, we are going to look at liquidity traps, void, and pools. We are going to look at that so that you will be able to master those traps that the big players use to manipulate you into taking into a wrong position. So hang on, sit tight. In the next video, we will cover all these things so that you will understand how to avoid all this. Thank you so much.